When we start investing, we think it's a process of return generation. As we mature as an investor, we realize it is a process of risk mitigation. But when it comes to financial investing, the lure of somebody else's return always comes to the fore. 60% of new folios are under 30 years of age. My buying is inversely proportional to near-term return. We run bias checks on fund managers every now and then. And when you turn 40, you have the ability of holding allocations. In Korea, people buy 3 stocks. In Taiwan, somebody is buying 1 stock. And these 18, 20 stocks are running the world. I personally feel somebody who will really dig deep and can have that courage to buy some IT right now, maybe in 3 years' time, can see a change of events there. It's up to Iran to close the war. It's not up to the US. So the dynamics of war have changed.
Here's something the mutual fund industry doesn't say out loud enough. Most investors know exactly what they should do, which is start early, stay invested, don't chase past returns, and don't panic. They know it, yet most can't do it. Today's conversation is about that gap between what we know and what actually we do when the markets fall, when our fund underperforms, and when everyone around us has a different point of view. My guest today has seen it all. 15 years at Mirae Asset, nearly 3 decades in the industry. He's watched investors build real wealth and watched others destroy it, often in the same fund at the same time. He's not here to tell you the markets will be fine. He's here to tell you the truth. It's a privilege to have Mr. Swarup Mohanty, Vice Chairman and CEO of Mirae Asset India Investment Managers Limited, on the reality check. Thank you so much, sir, for sparing out time to us and talking to our investors.
Mega, thank you so much for having me. Always such a pleasure to chat up with both of you. So looking forward.
So my first question to you is that, probably over the last 3 months, most fund houses, uh, advisors, we have all been advising investors that it is a good time to invest given where the valuations were and where they stand today. I'd like to understand from you what are the real conversations which are happening in the investment committee teams at Mirai, and what is keeping your fund managers up at night, if at all. And I'd also like to understand for an investor who's been hearing this but still is not able to act on it, what probably investing today could look like in the short term, because we have heard this narrative long enough.
See, Mega, I think some part of it you only alluded when you started this whole discussion today itself. See, when you look at investing, two very basic fundamentals are you invest for the future, right? And you have to be optimistic about the future, otherwise, why will you invest? That's rule number one. Rule number two is you ask any fund manager, and so many of them have been on your podcast itself. At the bottom of everything, they will want to buy a good business at a good price. These are two fundamental basic principles which guide investing. Even if this is the guiding principle for a fund manager, it should be the guiding principle for any investor too, right? Now let's look at the underlying. Broadly, when you are saying you are investing for the future, it means what the mutual funds write down that past performance is irrelevant, should be brought down to zero. It's me saying zero is very easy, but is it got down to zero? Is something which I ask everybody. When I look at industry data, and actually you guys are a little contrary to industry data, so that's why I really am a fan of how you all approach your investors. Industry data says that 82% of money comes in just last 1 year return. That's where you narrow it down. It's okay to put returns as one criteria, but when you look at 80%, it seems to be the only criteria. Then you miss out everything about the fund, the characteristics of the fund, the style of the fund, and then probably the approach of the fund manager himself or herself, right? You're missing out a vast amount of character of what that scheme brings to the table. Second part is, when you're buying an asset, you buy it when the price is better. And clearly, when you look at prices of the same economy yesterday to last year or the year before that, the prices look much better than what last year was, right? But while assessing the portfolio, if you assess, is the portfolio cheaper than other funds? And there are various ways of assessing that, you know it better than me, then probably you will enter into an investment vehicle which looks more promising for the future rather than which has played out in the past. That's the two contrarian. If you just approach them very simply and be consistent on these 2 points over a period of 10, 12 years, a lot of wealth can be created, very, very contrary to the market. And that's probably on the minds of every fund manager. And we are no exception to that. We're sitting at a position where our portfolios have probably not cycled out in the last 1 or 2 years. So some of them are, we're sitting on some stocks which we think are very good and are looking at their lows at this moment. And if, again, bringing back that old principle of buying a good stock at a good price, some of our stocks are available at some good prices. So we are extremely confident of our portfolio, and that's what we check. What has been a little different about us this time is that normally you come to a fund manager not only for stock picking, but also picking cycles. This time around, our cycle has not worked out for a longer period of time than earlier times. That's where we are sitting. Apart from that, we check and these periods actually bring out the analyst to the fore. You go and check your portfolio, you check each stock and your view on each stock. You probably meet the management much more to check whether the same intensity on their order books and everything is in place or not. So those checks become a little rigorous, but after that check, if all the boxes are ticked, then you sit on them very confidently. That's where we are.
I think you made a very important point about, most investors buying funds which have done well in the last 1 year. I think all industry data clearly reflects that. And I think we tend to forget that, when you do that, you're buying past returns and not future returns. And that is something so important. So my question to you is that, you've seen this industry evolve. Probably, when you joined Mirae or, maybe 2000, 2008, when Mirae actually came into India, we had close to about 30 fund houses. Today, as we speak, there are more than 54, if I've got my number correct, and more are
55.
coming. 55.
Yeah.
So, there's also a problem of plenty, if I can call it, especially for the DIY investors. Now, when an investor or an advisor is deciding which AMC to partner with, what, according to you, are some non-negotiables? Maybe if you can let us know about two, three non-negotiables an investor or an advisor should look at. I think it's going to be really helpful.
See, I can tell you what I look at when I build my portfolio because everybody's approach is different. For everybody is right. I don't get into other people's portfolio, but when I approach my own portfolio, I have two, three things about selecting a fund. The first part is please understand, and we all agree on this one, that this is a fiduciary business, right? Every fund manages somebody else's hard-earned money. And when it comes to that, for me, one of the biggest factors that I choose fund is the clean track record of the fund from a regulatory perspective. That is prime to me. And any deviation from that, I will take exception to that one thing. That's something which, for me, from my investing perspective, is non-negotiable. The track record on the fiduciary capacity has to be sublime. That's point number one. The point number two, which I learned over a period of time, is also diversify in styles of fund managers. Otherwise, what can happen is if you are stuck with one style, your portfolio will perform together and will underperform together. So that I learned very harshly post COVID, quite honestly, as recently as that, as that. And post that, I mean, when I go into choosing managers, I look at differentiation of style. And then the third most important part is the fund manager sticking to the offer document or the investment strategy that he or she has spelled out, right? If the fund is deviating from that irrespective of the performance, I will get out. These are three broad principles that I base myself on. And then the third part, when I look at buying, my buying is inversely proportional to near-term return. Right. And I have two broad principles, actually one principle, which plays out to both the markets as well as the fund manager. If you support the market in its bad times, the market will support me in its good times. Similarly, if I pick up a manager who I think is fantastic and I support that manager during his or her bad times, he or she will take care of me in his or her good times, right? That's how simple it is. So if the near-term return of any category is high, that's the least money I will put my money to. And if you be a little contrary, then you catch buying a good manager whose performances or whose stocks have not played out, as simple as that. And secondly, probably you're catching the market at a time when the prices are low or the valuations are low. And see, it's a process of diversification, and three, four asset classes come into play. And you do that in a disciplined manner over a 10, 12 years horizon. More often than not, you'll be buying assets at good prices.
For us as well, I think integrity of the fund house and the entire team is the topmost, because I think if the processes and the people doing it are correct, performance is bound to follow.
True, true, true.
Yeah.
True. I mean, see, for a good manager who has not performed in the near term, is very simple that his or her stocks have not played out, right?
Right.
And I would rather be with a fund where the stocks will play out than with a fund whose stocks have played out. Not saying that those stocks
Absolutely.
will not continue to play out, but the chances of cycle changes, and it is a cyclical market, no doubt about that. So your additional purchase, I prefer doing that. Right or wrong, I'm not commenting. That's my process.
So my next question is, when I hear about, the different podcasts today, or probably, different forums at which, you advisors, the fund managers speak, I think there's a huge tilt towards behavioral finance. And rightly so, because most of the returns are actually made by the investor's behavior. However, when I hear these discussions, I find a lot of it is very theoretical, right? Uh, an investor needs to probably look inward to see
True.
whether he is actually sticking to those philosophies or not. And a statement which you recently said in one of your interviews, that your redemption statement is your true behavior check, was something that actually stayed with me. So what are some other hacks that you could probably share with us which an investor can use to look inward?
You said it bang on, because the only thing that we can control is our behavior, right? And if we don't have control on that, then you don't expect the other factors to favor us. Charity begins at home, right? So when you look at that, if you don't control that, that's the only controllable. And you have to have a fair view of what your behavior is. Only if you introspect your own behavior and look at what you've been doing, you will come to know whether you're right or wrong. That is why when you make that purchase, that is not the most important part of your investing journey. Your most important part of your investing journey, and that's something which both you and Harsh do, is do a very thorough review and rebalance of your portfolio. That's when your behavior is checked. Okay, we had thought of this, and then are we deviating? If we have deviated, where have we gone wrong? And if you are right, then what are the stuff that we are doing which is keeping us on track? As simple as that, right? So that's why I pointed out redemptions, because it's a glaring thing in front of you. Now you've thought of something. Of course, a lot of data and mind would have gone into prompting a redemption. Nothing wrong with that, right? But over a period of time, are you revisiting that behavior to check whether that behavior has been right, or has it been more emotional than data driven? If it is more emotional, then it will tilt towards noise more than anything, right? The whole objective of investing is to make it as less emotional as possible, and more mathematical as possible. And then look at it. The other part which I always point out is you fixed on a goal for your portfolio. From that goal and time comes that return projection. Suppose that return projection is 12%. That 12% is all that matters to you. It does not matter if somebody gets 42%. If you are 12, you're good, you're going home. You demonstrate that, and please check if what I'm saying is wrong. You demonstrate that in all other asset classes. But when it comes to financial investing, the lure of somebody else's return always comes to the fore. Now you've done everything and you bought a 3-bedroom house. Of course, a 6-bedroom house is fantastic. People don't get lured because they know that 3-bedroom is their need. This is your finances. And hence that 3-bedroom is good for you. For some people, it might be 4 bedroom. Some people, it might be 2 bedroom. But always for a 4 bedroom, that 8 bedroom is better, right? If you are behaving in a certain way there, why not here? Since you asked me what is the other thing, the other simple thing is just put the portfolio return. And if that portfolio return is on track, you are on track for your goal. Now, if you want that goal to be enhanced, you can add a little bit more. But it cannot be driven by returns which have already come into the market. That return belongs to the investor who has invested there and not with you. And that, for me to say, is very easy. For someone to do is extremely difficult. You know, a friend of mine who's very pedigreed private banker, somebody from your side, once told me that private bankers should be at least of the age of 40. I said, what are you saying? And India is a young country, right? 40 is fairly old in our industry. I'm like ancient right now in the industry. When you say 30 years in the industry, I cringe, right? But I asked him why 40. And he kind of said that when you turn 40, you have the ability of holding allocations. And I am being honest with you, I could hold allocations post 40. There's no science behind this. But right now, at my age, what I like about myself as an investor is that irrespective of what market says, if my portfolio return of 11.5, 12 is maintained, I'm good with my funds. Secondly, yes, if markets can go from here to there, but if I'm committed a certain portion of my portfolio to that asset class, I will hold that portion. Nothing can, kind of take me away from that allocation grid. But that has happened after years of making these mistakes, of years of reading about my money, of years about thinking that, this money is my only friend when I grow old. Right, right. These are three realities that you will face with. Just two things that I leave behind is one, I think, if there's a portfolio return and you're getting that return, you should be incredibly happy and lead your life doing things that you really want to do and entrust that money to advisors like you. And second, most important, I think there's so much material available. Read a little bit more about the money where you are invested. Why I say this is I meet so many people who said, "Hey, I'm invested in your fund." And I ask simple question, which fund? Oh, let me tell you. I meet so many people. You ask them about the model of the car, they'll tell you what's under the bonnet, right? But that part, if you know, then you'll understand where you're invested well. And then marrying your investment need to your portfolio need is the key to financial success or financial investing success. I think if one does that, then one can be a happier investor more than anything else.
Thing I'd like to probably share, which is that, when an investor is investing, they're so obsessed about the return. But, I've sat across so many investors who've probably been part of restructurings or retirement or, extended career breaks. That point in time, nobody really asks you about the returns. All that they ask is it good enough to last for my
Exactly.
lifetime? So I think the whole obsession about chasing returns is wrong in the first place. We forget the bigger important picture that is more important.
That is why reading about behavior is more important, right? It's a behavioral trait, right?
Right.
Recency bias, as we call. The past recent thing really haunts you. But the same person does not demonstrate that in other activities of life, right?
Right.
Somebody has gone off to Antarctica, and that's the hottest thing on earth. Very few people actually go up to, oh, Antarctica might be risky for me. I want to go to Antarctica. But you have to take into account there's a certain age to go to that place, right? It's like that. But when it comes to financial investing, and that's why the need for somebody to guide you. I feel, you can choose a fund. You can be brilliant enough to choose a fund, but staying invested in that fund is the role of a guide. And that's where I feel, I'm blessed to have some and who've come out and point out some biases, which, no, Swarup, this is not what you should do. But over a period of time, I've been able to get it more mathematical. And then today I'm at peace knowing that my portfolio is giving me the return I desire, and that return will take me to my desired final destination. Then what else do I want?
So coming to the funds, So, some of your flagship funds, like the large and mid cap now, have had stellar returns. But, they did undergo a period of underperformance. And it happens with every fund manager. I'm not calling that out explicitly. But what I'd like to understand from you is something different. We often speak about mean reversions, that a fund which is in Q1 moves to Q3 and Q4 and vice versa. I'd like to understand that, what were some of the checks and balances you put in place at the fund house when the funds were underperforming? Number one. Number two, did you really see mean reversion happening to the extent you would have expected it to happen?
No, this is a very pertinent question. I'm so happy you're asking me this, because that's the root thing of everything, every fund house. Our job is to take care of other people's money, and we should be answerable at all points of time. Now, let me take you back to, say, post-COVID, okay, or just a little behind COVID, because prior to that, even during COVID, we were Q1, not Q1, we were Q1, right, for a stretch of
Right.
14 years, to be fair. But the underlying has changed dramatically. And please bear with me when I say this. What happened was, typically there was a very concentrated, say, PSU rally, which brought out funds which were, say, allocated or a little over allocated to PSU, and they got returns. Suddenly, post that, we had an extremely narrow defense rally. And think of what I'm saying, right? So people who went there caught that cycle and sort of delivered. Then there was this international allocation, which then spurred some returns, right? As we speak, somebody who's over allocated to healthcare will probably deliver that return. And I personally feel somebody who will really dig deep and can have that courage to buy some IT right now, maybe in 3 years' time, can see a change of events there. The simple point I'm making it is, you have started generating returns by over allocating to a small part of the market. That's been the last 4 or 5 years story. In that, a pure diversified story like us does take a back seat. It doesn't it's not a fact that it doesn't bother us. It bothers us immensely, let me tell you. We don't like being in Q3, Q4. I've been the first person to call ourselves out. We've been at a certain level, and then the next 2, 3 years are looking like this is not going down very well within ourselves also. So we go into the portfolio, we track each stock. And like I said, the analysts are probably at their most hardest working, if there is any term like that, rehashing each stock, going back. Our head of research probably is talking to each company more in a more frequency than we would have otherwise, right? That is what has happened over the last 2, 3 years. But the realization were two. One, which I pointed out, probably alluding to my own portfolio realization, it came from there only. There were a broad part of our fund management team, or practically the entire fund management team, following one style. So we were Q1 together, and we went to Q3, Q4 together. Correct? And all this you can substantiate with data. So then we said there is an absolute need at an analyst level and at a fund manager level to get a differentiated style. So we went in search for differentiated style managers. And that's when, if you look, and it'll relate to you, that Varun came in with a very differentiated style. We had Abhijit, who's managing the banking one, who's completely differentiated in its approach. Uh, uh, his banking fund actually is underweight in a lot of banks where we are overweight on the other side. So finally, we have broadened our fund managers at the back end. We have this ability to now tell you 2, 3 styles within ourselves, and that probably in the next 4 or 5 years will come out to play. That was a correction we made. But at the end of it, when we look at some of the broad portfolios, barring one fund, which is the focus fund, I can say when the reversal happened last year, we saw the reversal. Yes, it's not to the effect that we want, because we feel some of our price targets for our stocks are still far away. And that reversal sort of showed us that we were on the right track. And when the cycles change, we can also be back. But here's the thing, when you've backed your stocks, and correct me if I'm wrong, I'm just thinking aloud. You backed your stocks and you're sitting at a time when the stocks are very well valued. What do? You stick with them. It can happen that you change and those stocks run. in the change of cycle. And that requires patience from a fund management perspective. We run bias checks on fund managers every now and then, and let me tell you, some of those bias checks have come out to showcase some of those instances. And what I really like about the fund management team is the first time we ran it, and then it went a little silent, and they said, "Can we have this report every quarter?" And that really probably was one of my happiest days in those investment committee meetings. That yes, one is open to such. Because when you run a fund, you kind of think you're doing the right thing, but somebody said the risk department comes and shows you something, and you say, "Okay, I want it quarterly," is a great thing to see as somebody who's not from the fund management team. But I think we've hashed it all out, and we feel our stocks are doing well. Some of our calls are yet to play out, and I'd like to be in that position. Yes, what it requires is a lot of patience from investors. And I've seen in the past that there have been some stellar fund managers who investors have lost patience on. And just after they lost patience, those funds performed. And those instances have actually helped me sitting on this chair and in those IC meetings. When a fund manager is absolutely confident and is diversified, sitting with 40, 50 good stocks, you back that story, right? That's where I come from. Yes, it's never been 2.5, 3 years, Mega. You've tracked us for a long time. That's the only other side. We've never been on this side. But when you look at globally what's happening, I think it's reflection of what's happening globally. Globally, people are buying 14, 15 stocks because the returns have now become that, right? In Korea, people buy 3 stocks. In Taiwan, somebody's buying 1 stock. And these 18, 20 stocks are running the world.
Right.
Should a diversified fund do that? Is a question I leave on you. Will we do that? No, we will not do that. In a diversified fund, we have thematics which will run that play. But in a diversified fund, we'd like to remain diversified. And we feel at a macro level, and please check what I'm saying, India is probably one of the diversified stories of the world. The kind of diversification, forget the broad market, just the diversification the capital market index is not comparable to any in the world. And then it's a matter of time that this will play out. Will you be there when it plays out? Is up to you. We want to be there when this plays out, so we will hold firm on our allocations.
I've been interacting with you personally for the last 8 years, and I remember our earlier conversations when you were not of the camp, especially for liquidity reasons, on the small cap space.
Yeah.
And you launched your small cap fund in January of 2025 when a lot of industry veterans went public and said that, this is a time to book profits in that category. So I want to understand from you that, was it a deliberate contra call that you took as a house? And what were you seeing which, others were not able to see? And for an investor who's probably reading about so much of froth in the small cap space, what is it that you would want them to truly understand to help them, stay invested, in a small cap fund, which probably needs at least a decade to, for the returns to actually show out the way it does show out?
Yeah, you've tracked us long enough for to understand what I'm trying to say is that we never try to time the market. See, for us, a fund launch is decided by the fund management team, right? And it's when they say we can manage the fund, we launch the fund. We didn't launch a small cap fund, and you look at our portfolios before that, because before that we were practically a large and mid fund house. We didn't have that specialized small cap manager, and we still believe, and it's something which should be known by everybody, that the small cap investing is a very different mantle to large and mid cap investing. And then when we launched, when we got Varun, so we got Varun, and we were lucky enough to get him on our side, and hence we launched because Varun came on board. Luck would have it that we got some good prices when we bought, when market was completely contra. But like you rightly said, and then see, the small cap space today, 2 things I stand corrected. One was my earlier view on small caps, because at that moment of time, small cap, my view or the broad view of illiquidity, lack of stocks, lack of opportunities was absolutely correct. But what's happened in the last 3, 4 years is this incredible plethora of IPOs which have hit the market. And some incredible categories have been setup, which will become industries going forward. I mean, one, obviously, I can quote the mutual fund industry. The AMCs have gone public. A lot of hospitals have gone public. A lot of chemical companies have gone public. We feel a large space of healthcare has gone public. So most of 80% of the IPOs are in the mid and small space. That's given fund managers a far broader space than it was, say, 5 years ago in investing. In 2016, we stopped our mid-cap fund saying that there are no ideas. And today, 45% of the industry flows go to small cap, just speaks of the difference in the landscape. Second, I think some of these market caps have become fairly decent. Yes, liquidity remains an issue. That's where the reason for being diversified. That's why always at a fund management rule, we are very cognizant of the amount of free float we will own. Free float is the number of shares available in the market to trade. We cannot own beyond a certain percentage. And we are absolutely clear on that. Some stocks which we love and we hit that free float percentage, we just don't buy. And some of the reasons we've not caught some of those highs is we have not over allocated that. See, when we start investing, we think it's a process of return generation. As we mature as an investor, we realize it is a process of risk mitigation. And the closer your portfolio is to your risk profile, happier you are as an investor. Now things are going great. These risks normally don't come out, but it comes out on a day you least expect. So our job as a manager, apart from generating returns, is also look at the risk-adjusted returns. And then this is a big part in small cap. So it was not by timing, but we believe the NFO is the starting point of any fund. And like you rightly said, over 10 years, 12 years, this track record will speak for itself. We're probably the only fund house where none of our funds are below the NFO collection amount. Because we build track record, then we come to you and say that, 3 years, 4 years we build, maybe this is a good time to start buying that fund. And then that's the process we followed, and the small cap is not an exception. But as a fund house, what it did to us, it did broaden our number of stocks we now research. I mean, our landscape is now at 490, 495 stocks. This used to be 167, 8 years back. Right? The choice to fund managers across has broadened because of the addition of this space. So it's really helped us.
Fair point, sir. And taking a leaf from what you mentioned, even at our end, if we like a particular fund or fund management, still we don't over allocate in that because, like you rightly said, risk management at our end also becomes very, very important. Now, Mirae is known to be a fund house which plays by the book, which is relatively conservative than many other fund houses. But when we look at the allocation in IPOs, like you mentioned that, the ideas have come up and it looks very, very exciting. But
Yes.
there are a lot of companies where you have invested, where the companies are not showing signs of profit or the profit versus valuation gap is significant. To name a few, Paytm, PB Infotech, Delivery, Nykaa, Swiggy. I mean, you have all these stocks in your portfolio and a lot more as well. Now, there is another view in the market which feels that private equity or promoters, when they come out with IPOs, and in last 7, 8 years, we have seen more offer for sales. I mean, now Geo is changing the trend where they are saying we are not coming with offer for sale, but the historical trend has been that 60% of the IPOs have been offer for sale in the last 7 to 8 years. Uh, do you think there is a value left for the investor because you invested in these? And what was the thesis to invest into those?
It's, it's a very good question. And what you said is something which I also want to discuss. Because two things. One, this is a business of ideation, right? Fund manager should ideate. Fund manager should look into companies which he or she thinks will do well in the future. And then the IPO is probably the starting point of that the journey of that company in the public space, right? Now, I'm not allowed to take stock names, but in probably the first name that you took has been one of a very good contributor to the NAV in our portfolio because we bought across levels, right? And it did make good money for our, contrary to the beginning of the NFO or the IPO journey. Now, some of the portfolio companies, recently I got a lot of flack for us being anchor book. I think I was telling this to an anchor that you did mention us on the uh, uh, board that they put up. And when that stock has done well, you should come back and issue a rejoinder. How come this stock is 20% up or 15% up, even after a change of hands of what you alluded to, one large promoter getting out of a private equity person getting out of even that. But see, you have to take a call on future businesses. What has happened, and it's a change in hand, is that earlier the investments were in companies which had done a brick and mortar balance sheet in place. In this new era, you have to start taking calls on some businesses which will perform. And when you allocate, you hardly allocate any amount of your overall AUM. But not owning that story can become detrimental to you in the future is also a view. Look at the world. Here is this one company which has said that this is my business, and this business is not on earth, it is in space. Valuations be damned, investment bankers be damned, this is my value, right? And the whole world is preparing to give money to that one company in the next 2, 3 months. That's how some of the ideation has changed. Out of the 61 IPOs that we have invested in, I'm not at the liberty to tell you the amount of money we would have made in them, but barring 7, 8, out of which two are really not very good, but broadly, all other companies, we are in the money, right? What the investor should know is the IPO price is one price, and luckily for the industry and luckily for us, we continue to have inflows. Unless your bias report shows up that you're going very contrary to the flow of the business or the order book of that business or the projection of that business, you can actually make money post IPO by buying at certain levels, which is very simple SIP kind of a thing. Not that we do an SIP, but there are instances in the market which give you good opportunities to buy in later and hold good. But broadly, if we are an anchor book investor, we will behave like an anchor book investor. We will not behave like a trader, and that we have demonstrated with a lot of our anchor book that we've built it. But again, please understand, and there's a lot of hue and cry on social media. I would really request all those people to come back and check some of the prices post IPO. Typically, if the IPO goes down, then a lot more discussion happens. And if the IPO goes up, everybody becomes quiet. And that's not fair. Look at both
No,
sides.
totally agree, sir. I mean, the first name you mentioned, I remember when the IPO came, there's a lot of chatter, not just in social media, but in mainstream media also. And at times, I feel certain people in the mainstream media also behave not in the interest of holistic picture of the portfolio, but they also become short term
No,
because they
but
need
that
TRP at the.
really, Harsh, I'm not allowed to disclose regulatory wise, which is the right thing to do. But it is a case study. It is a case study for us. And I really appreciate the fund management for taking so much of flack. And when the end result is this way, you actually realize the mental of these talented people, their ability to dissociate the noise from the world. And there was a lot of noise, to be fair, right? And buy at certain levels so that at a certain level you start making money. And that really happened. It was a case study to me also. I've gone into that room and saying that, why are we taking this noise? But they were unfazed, right? And that teaches you a lot about investing.
Absolutely, sir. So now, since most of the investors who watch this, they also want to know about the market in general, and
Yeah.
we haven't kept too many questions on the market, but one question which we want to understand is on asset allocation because you are a strong proponent of that. So at this point in time, what looks attractive and what is something you want to avoid? I mean, if I have to take a basket of assets, fixed income, equities, Indian equities or international equities, precious metal, what is it that as a fund house you feel there is a good amount of value where risk reward looks favorable, and what is it that you want to completely avoid? And this question is all the more relevant for you because you are parent entity based out of South Korea, and you mentioned about 2 3 stocks contributing to the entire rally, rather 2 stocks to be precise. So if you could give us a color on
The
that, that
third
would be
stock
really
is Mirae.
helpful.
Mirae
Yes.
has also done very well. Yeah. So no, Harsh, I think very important question and the right question at this moment. See, I've mega kind of spelt out my age and everything by putting 30 years of experience in front of everybody. But in that 30 years, when you look at markets, and there have been very rare cycles like we are in. At this moment, for some reason, the economy which is going at 6%, which no other economy is growing at, is out of favor from global flow of money, right? Not because of our positive or negative, but there are opportunities elsewhere. And like I said, the world is buying 12, 13 stocks or maybe 15 stocks. Our Thanks to that, a lot of money has gone out, and some of these companies which were looking expensive last year are looking better this year. I mean, there's a 12% or 11, 12% absolute fall on the Nifty 50, right? But then the other thing which I'd like to tell people is that when you look at the broad basing of the market over the last 2, 3 years due to the new IPOs coming, the better reflection on Indian markets now graduates to Nifty 500 over Nifty 50. So that's something which people have to keep in mind, that a lot of money will be created or wealth will be created beyond the top 50 companies. And that's the beauty of Indian stock market at this moment. Because of this adversity, the equity markets are available at a cheaper price than what they were last year or last to last year. Point number one. Point number two is when you look at the global adversity, and I firmly don't believe that the end date is near to the global uh, uncertainty or post tariffs tremors that we've seen in the world, right? I will not believe that a certain signature has ended the war. It hasn't. And see how wars have changed. We are talking about the two largest, what can I say, military bases, Russia and US, at war with two relatively smaller companies. One small company has held Russia for 4 years now. Country, I meant. And the other one is that's up to Iran to close the war. It's not up to the US. So the dynamics of war have changed also. And the reality of this small strip of water on our personal lives is just been telling, right? Now, in that adversity, the interest rates or the yields are there's no reason why we will not see another spike. At this moment, debt from a longer term perspective also looks pretty good. I mean, that bank FD also will start giving you good returns if look at it from 2 3 years. It's just around the corner, right? Debt also looks fairly in favor of investors. And I disagree with people looking at price in gold because they've never done that in their previous purchases on Dhanteras or whatever. And then you're changing behavior. And then please, here's my only submission to people that when you bought gold over the last 2 3 generations, you've just gone and bought that asset class without looking at price. So for heaven's sake, when you're buying that asset class, still don't look at price. You will spoil it. Please bring that old behavior of buying gold every year without looking at price to probably your equity buying behavior. And for heaven's sake, don't take your equity buying behavior to gold buying. But thanks to the price correction, the commodities also look pretty good. Please understand at a macro level, this time around when the adversity in the world happened, the sovereigns went to gold, not to dollar. At this moment, the sovereign reserves globally are more than dollar reserves. Never happened in 30 years. The point I'm making is rarely does it happen that opportunities are there in all three asset classes together. Rarely. And that is why that proverbial term of asset allocation brings everything to the fore. It is your behavior which will determine your wealth creation. And when you look at it globally and you look at mature nations like US or Europe, people buy more multi-asset strategies than a single asset strategy. The possibility of getting median returns is higher in a multi-asset strategy than a single asset strategy. And in markets from here on in the next 5, 10 years, probably that will also play out for Indians. And then that's something which Harsh, I know you do it very efficiently. So people should look at allocating prudently and more important, holding on to those allocation grids for the next 5, 10 years. Prudent wealth can be created through this process, not by concentrating on one asset class. Yes, at this moment, since you talked about international equity, personally, I think it is favoring Indian equity over international equity at this moment. I would put my money more on Indian equity than international equity.
Fair point, sir. And just to the list, I would want to add one more instrument, which is FCNR deposits.
Yes,
Today, you are getting returns higher than what Indian FD holders are getting, and we are
absolutely.
getting
I
in
mean, that's
rupee
why I
and they are
said,
getting in dollars.
I meant FCNR when I said bank FDs, so for people abroad, a lot can happen through
Absolutely,
this
sir.
route.
So now you mentioned you didn't take the name. I would take the name SpaceX, and you mentioned about how there is a frenzy for index providers. There is a frenzy for retail investors to participate, and they participated in that as well. And the key thing in the prospectus, other than the voting rights and everything, was the TAM, which the company said. I think, if I'm not wrong, the TAM was upward of 27, 28 trillion dollars. Now, translating it to your business, and here the question is about TAM. uh, you would also understand, and as advisor, we also understand that not every client is meant to be dealing with us, and we are not meant to be dealing with
True,
every person on earth. And
true, true.
Mirae is not for everyone, and everyone is not for Mirae. So, for investors, what are the kind of, or who are the kind of investors who should be looking at your fund house, and who are those investors who you feel are a misfit and who should not be looking at your fund house for investing?
I think two, 3 points. One, I think it's very surreal every time I say this that we are the only organic global asset manager in India, right? And no other global asset manager has done it on its own in this country. Just speaks of our commitment to business in this country, the way we view this opportunity in India globally. Number two is that, please understand when you look at asset management business, uh, uh, we are true blue asset managers. We started the mutual fund industry in Korea. So this is our parent company. People come to asset management from other businesses. We go to other businesses from asset management. In India also, we started with asset management and we build other businesses from this business. So if our core business is anything, it is just asset management. So we understand this business as our broad DNA. The third part, which you said, who is good for Mirae Asset? I think we have a plethora of products across risk profile. When I break them into two parts, the active business and the passive business, active business is one which currently, like we discussed, is we do approach a risk mitigated, diversified approach. So people who look at that risk adjusted returns is probably good for us. And then uh, I think there was a discussion that we don't chase momentum. It's not that we don't chase momentum, but we will not chase momentum if a certain risky pocket is running away. We will prefer to stay away from that. So people who come to us should understand that. And if they understand that, then they'll be happy investors with us, right? Finally, you come to mutual funds for two things. One is diversification, so that the risk reward is better. And secondly, for the fund management expertise, Mr. Nilesh Surana, who's our CIO, is in this fund house since inception, right? And everybody talks about his risks, stock picking ability. I think people should look at his risk mitigation ability also. And I'm a big fan of the risk matrix which Nilesh puts in place. And that's why I've been a happy investor, not because I work here, but very unemotionally, very happy investor with the fund, right? People who should not come are people who will look at, over allocation to certain pockets and chasing momentum. Maybe they will be a little disappointed. But otherwise, when you look at the passive side, some incredible risky products are there. One can look at it from that perspective also.
Interesting, sir. And since you touched upon passive, and you have had certain products which were very sought after, and at some point to mitigate risk, you had to stop inflows, and there was RBI regulatory guidelines also. I remember NYSE FANG, where there was a lot of craze thanks to returns and
True,
thanks
true, true.
to concentrated bets there. So, trying to understand a little more on this, because when we have interacted with your passive team, we have been equally amazed the way we are with your active managers. And you have done phenomenal work in that. Not many people know about it. And that's the reason I brought up this, because index creation, which not many people in the country are doing, you are doing, strong team, a lot of products which are coming up, a lot of ideas where you're working on. So where do you see this active and passive going forward? Do you think passive becoming a major share of your business going forward, or how's it?
Harsh, thankfully, we are the manufacturer. So we are agnostic to where people will put money, and that is your role. And that's where it gets pretty tricky and becomes pretty skilled, right? Our job is to bring a product to the person, and then with your advice, they will buy the fund. So we are agnostic to where people put their money to. But yes, our job is to probably bring products across the risk spectrum. And then that's when you qualify as a broad asset manager. We have our equity active, we have debt. Now we are almost 35,000 crores in debt. We have the passive, which is around 25,000 crores total passive book in ETFs. And then we are building now a fairly pedigreed gift city business. And we're about to register in Dubai there in with our own fund there. And then more important, I think the SIF part is also beginning to unfold. What started as a long equity fund probably in 2011-12 is now a diversified manager. Now, what happens on the active side is there is categorization of funds. So the number of funds you can ideate or launch or whatever is limited to that categorization grid. That actually opens up ideation on the passive side. And wherever there is an investable universe, you can create an index. And on that index, you can create a fund, and through factors, you can actually give multiples of that fund, right? And now when I look at my active portfolio versus my passive portfolio, not sharing the schemes that I've invested outside Mirae Asset, some of this, I think all of the schemes have really caught the momentum. But why my passive portfolio outperforms my active portfolio is it doesn't have silver, the active part. Silver, even after correction, is doing incredibly well in my portfolio. The manufacturing index that we put, and please understand, this is a performance without manufacturing still not taking off in a big way. So a lot will happen now. The manufacturing index has been a rocker, has done very well, and clearly, when you look at the small cap space, there have not been many funds which have actually beaten the index on the small cap space, right? So when you look at diversification of portfolio and getting in ideas which can make your portfolio better, I feel a mix of both can actually make your portfolio very strong, and that's where we are positioning ourselves. I agree. 31 of our ETFs are inbred. We've actually created those indices. And then at the underlying, the demography is becoming younger. 60% of new folios are under 30 years of age. We feel they need a different approach, and a lot of those products might come from there, right? So that's our basic thing, to give newer, better products or newer indices on that side, which can then build over a period of time.
Absolutely, sir. And we totally resonate with that, because when investors ask us this question, we say that you can choose either, because this is still much better than doing stock picks on your own, because there is no risk mitigation. So a
Yes.
diversified index is always better on that front. Since we are toward the end of our conversation, a few rapid fires. First, one thing which you absolutely don't delegate.
I think I delegate everything, but broad my own personal relationship calls that I don't delegate. So if I have to meet you, I will meet you. That will remain perpetually, and I'll walk the talk on that one. See, I built certain relationships over a period of 30 years in this industry that I will not delegate to anybody.
Absolutely, sir. And there is a joke in the industry that your RMs may not take call on Sundays, but you take calls on Sundays.
See, it's not that, but I respect the fact that if somebody is sending a call on Sunday, it better be very serious. It invariably is very serious.
So on a scale of 1 to 10, how happy are where Mirae is at the moment?
See, I'll put that at 9, and not because of the fund performance. The focus could have done a little better, But at a conceptual level, we pride ourselves of conceiving the fund structure and everything so well. We should have really understood the risks of a 30 stock portfolio in Indian markets. I'm not talking about performance at all. Performance is an outcome. But I think structurally, that we should have envisaged that if this fund becomes 10,000 crores in 2 years, what are those risks that can unfold? That's something which I think we are discussing very honestly within ourselves, and that's something which maybe as a CEO I could have done much better.
And so, one thing from your experience of 30 years, which you feel investors have not been adequately informed about?
I think the risks, I think something which even today, suppose a fund is generating returns by allocating to a small pocket of the market, the risk profile of that fund should be also informed better, is my opinion. I can be wrong, but I think investors should always know if any change in risk profile has happened. Just the riskometer will not reflect that. We have to go deeper than that.
Absolutely, sir. And one call which you got wrong, which still haunts you?
On the fund side,
Yes, sir.
no, we are okay there. I mean, some of them are errors of omission. I'm really happy that whenever some wrong stocks have come up, they've never featured in our portfolio. So sometimes we get into the wronger end of the company, but none of our company portfolios have been called out as anyway irregular in the market. Secondly, on the debt side, we've never had a credit fault issue with any of our portfolios. So there, I think I compliment them. Now, where we've probably missed out, or sometimes our cycles have got elongated of not participation. That's something which one has to reflect on going forward, because the investor wants what instant gratification. Somewhere that some of those thoughts are going on at the back end as we speak.
And so one last question in a lighter vein, given the performance of Kospi, do you think you would have been happier had you been heading Korean unit instead of India for last 2 years?
No, not at all. Because that market had see that index fluctuates at 8-10% a day. Initially, we had a China fund which we wound up because the transparency of those markets were not what the transparency of India was, and we thought if we can't give transparent answers, better not to manage that fund. So we wound it up. At that point of time, there was a lot of demand. Why don't you get a Korea fund? And I'm talking about 10 years ago. Our head office had said if you cannot manage a China fund with the volatility of China fund, your investors will have a heart attack with a Korea fund. And look at their market, 7% up, broad market, 7% down one day, 10% up the other way. It's a very difficult market. I mean, broad-based fund management better in India.
Absolutely, sir. So with this, we come to the end of our conversation, and what a conversation it's been. A lot of learnings, and I'll just summarize a few pointers before we end the conversation. So one is about diversifying the styles in the portfolio, as well as at your end, diversifying the styles in your fund management team. One interesting thing which you said was buying is inversely proportional, or buying should be inversely proportional to the recent performance. And I think that's very, very apt. Third is that purchase is not important part of investment journey, but how you behave while redeeming, what kind of thoughts go into that, that's quite critical. Make investment more mathematical than emotional, though it's very difficult to do in practice, but that's something which you think most investors should go by. When you buy a house which is 3 BHK, you don't keep looking at 6, 7 BHKs and keep feeling jealous about. On the contrary, is at times we feel smaller houses are better because a less headache of
True.
having helps and everything. But in portfolios, when we look at somebody else doing double than us in terms of returns, we feel very anxious about that. One can choose brilliant fund managers and brilliant fund, but staying invested is what makes a difference, and not the first part of choosing the fund. Diversification story of India looks very, very strong. You said that, you clarified about the IPO part, where a lot of social media chatter happens, that only 15% of your IPO investments have not yielded the desired result. And it's not that we should look at the IPO price and today's price and make assessment that Mirae is not making returns, because there is a lot of action which happens post listing also, and that prices and that valuation at any point of time is also, could be an entry point for you, and where you could end up making decent return over a longer period of time. Lastly, you mentioned about Indian equity, fixed income, and gold looking very, very attractive. And you also mentioned how one should look at buying gold because there are no real matrices on, there's no cash flow, there is no discounted cash flow which you can do here. And one of the last thing which would stay with me from this conversation, which is very important, which you reiterated multiple times, which you don't see many portfolio managers or CEOs talk about, is that risk mitigation is more important than return generation. And I think that's a lesson which I would want to carry home. And that's something which I would want all investors to seriously consider, that when they are investing, risk should be given equal importance as they give to returns. Thank you so much for taking out time, sir. I'm sure this is going to add a lot of value to our viewers, to our investors, and we can't thank you enough.
Thank you so much for having me. Always, always such a pleasure.